Welcome back, folks. Back in the saddle again. All right, so we're looking at the weekend edition for January 9th, 2021. This lesson, we're going to be talking about factors in avoidance. Obviously, we're going to be looking at the dollar index, euro dollar, and cable. But I want to teach a little bit and talk a little bit about how I determine whether or not there's a market that I generally like to follow, but I'm keeping my hands off. Now, obviously, you've known for a number of weeks and months now, I've been avoiding cable. I'm going to show you some of the things in the chart that led to that determination. Despite it moving sometimes like we were looking for it, that's not enough for me to say, well, I've changed my mind. I'm going to now start trading it. I'm going to show you certain signatures in price that helped me avoid trading that particular pair, and why our focus was primarily on that of euro dollar. All right, so we're looking at the economic calendar for the week to come. On Monday, we have medium impact for Canadian dollar at 9:30 a.m., Bank of Canada Business Outlook Survey, and ECB President speaking for medium impact for euro about 10 minutes after that on Monday. On Tuesday at 5 a.m., GBP has medium impact speaker. And then Wednesday at London Open 4 a.m., euro dollar has a medium impact speaker. And then 8:30 a.m., dollar has CPI. And on Thursday, we have unemployment claims, medium impact for the dollar at 8:30 a.m. And at 12:30 p.m., high impact Fed Chair Powell will speak. And then Friday at 8:30 a.m., high impact dollar, core retail sales. All right, with that, let's get into our lesson and commentary. All right, so we are looking at the monthly chart. So I'm going to try to be referring to this not every single time we do a video, obviously, but when we start a new month, the first lesson in that month or commentary for that month of the year, I will bring in the monthly chart, so that way we'll be able to refer to specific things that this time frame would present us. The weekly chart will always be in the commentaries from now on, and then obviously we will still work within the realm of the daily, the 1 hour and the 15-minute charts respectively. So I also want to remind you that as we go into this new year, I'm going to be giving you the lipstick right away in this video because I want it to be a little bit quicker because I'm doing all this jawboning. But every video after this particular one, I want you to try to have your annotations in your chart before you watch mine, okay? Usually you see me doing very light annotations, and I'm drawing your attention to certain things. And while I do personally believe that that is the best way to do this from an educational standpoint, it does weed out the lazy, but there's also some folks that are coming through and they're in month 3 or 4 or 5 and they start feeling that pressure. They're like, I'm running out of momentum. I'm running out of inspiration. I see the stuff that's being taught and I see the things unfolding in the chart, but I just can't resonate with it yet. So this year, over the holidays, I've made a decision. I was going to provide a little bit more of what it is that I like to see in my annotations. Now, clearly, it's not everything, because in my charts, I'll make reference to certain things that I'm not going to divulge publicly. That means even in here. So, and what do I mean by that? Like orders that I would take for a trade, areas where I would use my stop, and where I would take my initial profits, scaling out, and things like that. Framing my actual trade. So you're not entitled to that, and because I don't run a signal service and I'm not trying to give you trades, that was not what you signed on to. You signed on to learn how to read price action, which will at some point take you to a crossroads, and you'll determine whether or not you want to voyage into live trading at your own discretion, not by anything that I would instigate or prod. In other words, I don't say, okay, now start trading live funds. So without saying anything more and boring you, just know that the annotations in the chart will be a little bit more richer as we go through this year, but we're going to warm up with very light annotations because of the time of the year. As I mentioned on my community tab on the YouTube channel, reminding those that are already here, and also providing as a free service to those that watch and read my community tab, that January generally is a month where everyone on the institutional level, they basically do a lot of planning. They do a lot of analysis and sentiment reading and try to determine what next intermediate term trend may develop, okay, or which intermediate term trend may be ending. Okay, so it's a matter of being flexible. All right, so we'll talk a little bit about that, but mostly what leads to me avoiding a particular pair and what things should be in the chart, or what things that are in the chart that lead to that determination on my part. So hopefully that'll help guide you. And just know that this isn't a lesson where you watch it one time and you're like, oh yeah, I know how to do that now. It's not like the last up close candle is every bearish order block. That's just the same thing. You can't just take one lesson like this and walk away thinking you understand everything. It's one of those things that experience is the best teacher. All right, so monthly chart for the dollar index. Okay, so we've seen how the market came back up and hit here. We already outlined all that. We anticipated that nonetheless, not on the basis of it being this particular level, but I'm bringing in the levels from the higher time frame that led to a lot of the things you heard me say over the past few months. We have a rejection block in here, which is the last down close candle's closing price. Then we have the sell side liquidity pool resting below this old monthly low. We have yet to trade down to the rejection block, so we'll see if it wants to do that at a later time. Right now, it looks like it may want to dig into this sell side imbalance, buy side inefficiency a little bit. Does it need to come all the way back up to this candle's low or even revisit this bearish order block? I personally don't think so. I don't think that's the case. We had a lot of events happen last week in the US, and that has sent some concerns throughout the markets, and sentiment is not clear. Okay, so what will happen is the central banks will start shaping that sentiment with price action. So while I'm still bearish and I'm looking for a run below this eventually, and then targeting this volume imbalance right here, you see that? So I'm looking for this over the course of the first 6 months. Now, that's a lot of time, Michael. You're saying it may take 6 months to get down there. We may have to go into a period of consolidation for a month or two because of everything that's been going on, U.S. elections, and the invasion of the Capitol building, all that business. So there's a lot of things and a lot of narratives that are presently on the table, and I'm not sure which one they're going to run with. And to be honest with you, I'm not sure they are really decided on what they want to work with, but they generally in January present some measure of consolidation. And more, well, if you look at this period in here, okay, beginning of 2017, we consolidated there a little bit. Wasn't a lot of price action movement. It just stayed in a range. Same thing in here. We worked inside of a range a little bit for a month or two, and then it finally left. So it doesn't take long to look at, the ideas of the beginning of the year not being in a rush. And we had this over here with 2020, okay, which was a little bit wild, but nonetheless, it's a time of the year where you have to relax and try not to rush, unlike retail traders that are just, okay, we got through the holidays, it's time to start trading again. The markets are open. That means I got to be trading. No. Okay. You're not trading just for the sake of trading. You want to be in high probability setups. And for those that are watching this, that are in the new group, they're not able to watch this video until they start coming in on the 27th of January. But I'm sure you'll be watching this video eventually. And I want to remind you all that this is something that we teach here as a general rule of thumb. January, and this is the reason why I sit on my hands and don't really trade until the first trading day of February. I use the month of January as a intel collection period where I'm just trying to get a lay of the land. I'm trying to figure out what they're most likely going to try to reach for on these higher time frame charts. And I work with that as a context for the next 6 months. Now, it doesn't mean I'm going to hold a trade that long. It just means that I'm looking for scenarios that would lead to that general direction. And as we get closer to that, or if we see something entirely different, then I can change my mind or change my analysis or just move to the sidelines altogether. Like you've seen, for those that have been in the mentorship for several years now, you know that there's periods where I get cross signals. So therefore I'm uncertain. So I say, okay, I'm waiting for more information and we have to wait. And you see why we have to wait. There's a general consolidation or a pause, or the market does something squirrely and it doesn't make any sense. And then it does something else that we anticipate. And then we get back in the rhythm of what the market's likely to do next. That's normal, okay? But we don't freak out, we don't lose hope, and we don't abandon the ideas because the market's not lining up something right now for us. It doesn't mean that the algorithm's broke or it's been changed. It just means that the markets are in transition. And what does that mean? We're transitioning from a trending environment, which is what we've had over the last couple months. Now we're at the beginning of the year when it typically will be range bound, okay? So try not to be terribly excited about any short-term price moves, and just have it in your mind that this is a normal instance where price doesn't generally create these sustained price runs right around this time. Now we're in unprecedented times, so that might be a little bit different, and it might upset the normal tendency for January, or the January effect as I teach it. So I give you a lot of preamble there, so we'll be able to go through the rest of the video pretty smoothly now. But I believe that this will eventually be a mark for the first half of the year. How much time we need to spend in here is unknown to me, and I'm willing to submit that entire month of January and not worry about it, and let it give me more insights as we go into February. So when we met last time, I mentioned how we could potentially trade up a little bit into a buy-side liquidity pool in dollar, and we'll look at that when we get into those other charts. Let's move into the weekly chart. All right, so we have a fair value gap right in here in the form of a sell-side imbalance, buy-side inefficiency. So one single pass here with this candle. Do we need to come back up into that? That's what I'm trying to determine, because we did dig into this consolidation with this drop here, and we've had multiple times going lower, and it's very difficult personally for me to get a read on what they may work off of, because just because we have went into this range, and we can look at the equilibrium of this price range low and price range high, split that in the middle and see we pretty much worked at that level. I am not trying to pick a low or a bottom in dollar. Now, when I am bearish on a market, I'm not likely to always be counter trend trading, even if the signal looks strong. Sometimes I'll just wait and let it pan out. For instance, it might trade up to that fair value gap. It might trade up to it and then create another opportunity going lower. Or it might trade up to that fair value gap, start to drop down and fail to go below this low, and then make another more significant price run higher. And then we'll have to wait at a longer time into the year, if at all, making a run below here. So that's the equation you work with. Now, if you listen to the language I'm using here, this is not how I usually talk. Usually I'll say, this is what I'm believe is going to happen. I'm siding on this side of the marketplace. So therefore, if it goes up here, I'm wrong. It's not a setup I would take, but I'm sticking to this narrative and it's likely to go there. Notice that that's not in this discussion. This is always how I view the market in January. So I am letting the market show me what it wants to do. And I'm not trying to take a trade. And if you are one of those individuals that are foolishly trying to trade with live funds while going through the mentorship, Do not try to trade in January. I don't care who says they made this or how many times you've seen your chart setups pan out. It's just not a good period to do it. Okay, just give up those couple weeks of the year. And I promise if you do that as a routine, you won't be in a rush to trade. You'll have a better view and a grasp on what is likely to occur February into March and April. That to me is a fair trade-off. Having more intel, more insight, more clarity, visibility, if you will, of what price may do. Whereas right now, really nobody knows. Okay, it could do anything where it's at right now. It could turn on a dime here and go right up into that fair value gap and even go higher. I don't know that. I don't know if it's going to consolidate here. I don't know if it's going to go down below this low. I would venture to say that it's going to retrace a little bit more if it's going to go lower. And we can watch the opening on Sunday. If it gaps up, fills it, and starts to rally back above the gap, that would be an indication that's near-term bullish. And then we could take our attention to this fair value gap. But the idea of having a very strong conviction that it's absolutely going to keep going lower, while that is my underlying bias, I'm electing to anticipate short-term retracements that could reach up into this fair value gap. It doesn't necessarily need to fill it entirely, but I do think it will be some measure of a draw on liquidity, at least from a weekly standpoint. All right, so the daily chart on the dollar. All right, so I have a couple things on here, and right away you can probably determine why I avoid doing this much annotations on my commentaries, because when we were having multiple groups coming in throughout the year, they would be starting with month 1, month 2, and they see things like this. Like if I don't say anything at all, imagine you don't know what you know, and I show you this chart right here. You're like, what is that? What are those levels? Why are those lines there? And why didn't he highlight this or that? You see what I'm saying? So that's why having annotations on your chart is a personal thing. But I'm going to guide you all this year with majority of what appears in my own personal charts. Okay, so while I don't dress TradingView charts for myself to trade off of, I use a separate platform. Now, right away, your mind's thinking, oh, well, that's the advantage. So tell me what that platform is. TradingView is perfect for you. You're developing, okay? You're not supposed to be trading with live funds. So what platform I'm using is of no concern to you. In charter level, once you get there, once we get everybody in the charter level now, because this is our final group, I'll start showing you my live platforms, and you can see my charts and things like, not on a daily basis, not on a routine basis, but you'll see that the way I do it in a quote unquote institutional platform, it's basically what you see me doing here in the education. So that way there's no confusion. There's no advantage over this or that. The charts are the charts, period. It doesn't make it, there's no advantage, okay? As long as the data is solid, then you don't have anything to worry about. But with looking at this chart here, I want to go over a couple things, and what I'm showing you is, now in my mind, this is how I see it, but in my charts, this part is not in the chart, okay? And what do I mean by that? I'm not highlighting this high, which I'm doing here, to note that range high. I'm not noting this low for the basis of having this range high and this range low, marked out. Why am I using this high to this low? Well, we have the market come down in here, trade up, and then we broke down through it. So I want to consider the potential of maybe needing to come up into this swing high without breaking it in a retracement. Now, I'm not saying it's going to go that far, but in terms of determining range, to work within a range like this high and this low, it doesn't need to go above this high for me to find opportunities. And if it does retrace higher, what levels could it potentially trade to? And if this is a breaker, which by all indications it looks like it is, and we broke through it here, I only want to use the nearest swing high in the context of this swing down. So every down close candle consecutively, that's your bearish breaker. So essentially this candle's low, extend it out in time. I want to go into the breaker, not just the butt end of the tail or the candle's close. I want to consider the entire range of that breaker, and that swing high is inside of this breaker. You see that? So I could have had a whole lot more annotations here, so you got to take notes with what I'm saying, and in your own charts kind of replicate what you see here and then fill in the gaps with what I'm saying verbally. Okay, so the audio commentary, those things you want to add to your chart. I just didn't want to have too many things on here, and the things that would otherwise be in my chart I'm giving you audibly. Okay, so but I want you to know that I'm not looking at the chart with this level here and this level here. In my mind's eye, okay, and as I look at price, I'm looking at this range and I'm splitting it in half. That's this level here. This is equilibrium. So everything below that level is a discount. Everything above that level is a premium. So if it's going to retrace to a premium at this level, what resides above that? Well, we have this short-term area here where there's relative equal highs. So we have buy-side liquidity there. We also have a volume imbalance there. Plus, we have a weekly fair value gap that it could trade right up into that for an institutional order flow entry drill. It doesn't need to completely close that in, but it could need to retrace back up into this level and this level. This level here, the dotted line, that's the 62% retracement level, and this is the 79% retracement level, respectively. From the high to the low, if you drop a fib on your chart, you'll see that that's what these are, which is optimal trade entry. So does it need to trade back up into institutional order flow? It might, but I don't know. But it will have to determine that if we trade to a premium, which is at or above this level. But if it gets to this level, we could anticipate a run into this level here, which would also be almost consequent encroachment of the weekly fair value gap. Now notice I've transposed the levels from the weekly and the monthly into this chart. So when we drop down from the monthly, the weekly to now the daily, everything has a better context. And this is the reason why I said the lazy don't survive here. But I guess I shouldn't say some, there's a lot of you in this most recent group that joined in 2020. They need a little bit more hand-holding. And because we have an enormous group coming in that starts on the 27th of January, I kind of like want to give as much as I possibly can in terms of hand-holding, so that way it teaches you by repetition what you should be having in your chart, what your chart should look like. But I'm not going to just show it to you like this when we do our commentaries. What's going to happen is I'm going to have the charts blank initially, and it'll be a way for you to say, okay, this is how he has his chart right now. And then what you can do is set your chart up with the same amount of data that's showing, okay, and then try to put the lipstick on your chart and pull out the things that you think are salient. Okay, in other words, what is most likely the most important things right now, given the current market structure, the dealing ranges that are available, and what PD arrays are likely to be traded into. And that way, you will have a day-by-day opportunity to test yourself. Okay, so it's not something for you to see you fail at and say, oh, I'm never getting this. Okay, I want you to understand that it's going to take time for you to start matching up. And most of you probably will never have it exactly like my charts until you become a charter for a while. But while you're in the core content, and here's the thing, the charter members never really had this. So they can go through month one, right now in January, and revisit all this stuff again and relive now with a little bit better, I guess, application of what it is, because they know what PD arrays are. They know most of the things that you are learning while in core content. So they have a lot better advantage because they've been here for a while and they've gone through some things. But you as a developing student that are new coming in here, then from the new group for 2021, you want to be doing what I'm showing you here in your own charts before you look at mine. If you don't do that, I promise you, if you don't find a period of feeling like you're not learning anything or you're not seeing something, okay, you will around the second or third month. If you're not somebody that goes into the charts and back tests and look at price action and study how the things I'm teaching appear in that, you won't feel like you're developing. So what I'm doing is I'm taking you by your hand and I'm giving you the opportunity to say, okay, this is what your chart should look like at the moment. And then you go into your own charts, pause the video, go into your own charts and replicate what you think is going to appear in mine. Now, what I don't want to have happen is for you to feel like, all right, I'm going to put this on my chart and I'm going to send it to you, or me rather, in email. And this is what I had in my chart, because if I had all of you doing that, my email box will have 40,000 emails in it and I'll never get through it. And it'll be a nightmare. I want you to think about the application of me sharing with you my charts. Okay, I'm going to be providing that to you as a way of helping you understand it. Okay, so when we do our weekly reviews, it'll be the midweek review and on the weekend. At some point, I may start doing it as a upload to the forum. I just don't know how I'm going to do that because I still have to worry about having watermarks and everything. So I don't know how I'm going to do that part. So in the videos, everything's grouped by user groups and usernames that you're not aware of, that we're giving everyone. That's not necessarily the username that you're given to get into the forum. So the watermark that's on your videos, that goes to a specific group of members that's in a member group. So if my videos start getting circulated, then I can see right away, oh, this is that group of 25. So now I got to just whittle down 25 people that's doing it. And it doesn't take long to do that. But it's important for you to put your effort into trying to determine, based on what you know at the level of your mentorship. So in the beginning, it's unreasonable for you to have any idea what your chart should look like. But by seeing a naked chart, which again, as a reminder, I did not do that with this lesson here. Just imagine all the lines and annotations that's on this chart here not being there, but just the price chart itself. That's how the commentaries will go forward. And then I'll say, okay, if you don't want to see the annotations, you need to pause the video now or stop it, because I'm going to add it and then it'll be there. Okay, so it'll help keep my focus on the discussion. And that's why I said this video is going to be a little bit longer than the ones going forward, because I really want to frame out your expectations on how I want you to see why we're doing what we're doing. Okay, so it's going to be more structured, it'll be more interactive, and it'll provide you a way to kind of like come up to speed a little bit quicker. But for some of you, you didn't need this, and I commend you for that. But I don't want anyone that feels like that this was the thing they needed to feel like they were less intelligent because they needed it. Because I used this as a way of weeding out the lazy. Because I've had people in previous groups come in and like every day I got 20 emails from them for questions that would otherwise be answered if they just did the things that I'm showing you here. Okay. In other words, they just want to have me give them everything, a spoon-fed response to everything. I'm looking at this chart right now, and really what they're trying to do is warm me up to telling them their trade idea is good, go ahead and take it, which I don't do that. Okay, so anyway, take this level off your chart, take this level off your chart, take this level off your chart, and these levels here off your chart, and this annotation of OTE, and that's leaving just this level and this level, and that's all that would be on my chart personally. But from a perception stance or a point of view, this is how I am internally seeing it. Okay, how I look at this run in price, why I'm using this high again, and I'm not sure if I did a good enough job, so I'll do it again here. Why am I picking this high? Because inside of this candle's high to this candle's low, because they're consecutive down close candles, inside this turning point that comes up to this high. So we had this high and this high. This is a breaker once this low is broken here. So when we had this price run all the way down here, if this is going to retrace, I want to look at and refer to the swing high that's inside, if there is any, because there may not have been a swing high in here. If this swing high didn't exist, or this one in here, then I would just use the butt end of the breaker, of its tail. Okay, in other words, this candle's low. I would use that as the range high, because that would be a PD array or a specific level that the algorithm would utilize. But because there's a swing in here, it may need to go into that last up close candle. And if it breaks this, then obviously it changes everything. But I'm willing to see it trade up into this candle because it's a swing high, but not break it. So with that, in terms of understanding the range, I'm using this swing high within the total range of what would be deemed a bearish ICT breaker. And what a breaker is we have a high, a low, price runs up, upsetting anyone that trailed their stop loss in here, and then it goes lower. Once it breaks that, then we have market structure, momentum, everything going lower, institutional order flow bearish. But if we're looking at a level now where, all the things that's been going on, the uncertainty in the US, and we're at the beginning of the year, if we need to retrace higher, this is the framework I'm looking at. Okay, I'm not looking at up here like this is a low resistance liquidity run. If we were bullish, like I would look for these levels here to frame out a low resistance liquidity run to that level. Now, if we run above and find some support inside this area here after going higher and starts to rally, then I would concern myself with that potential scenario and put this whole business down here at a later time in the year, or maybe even abandon it the entire year based on what we see and what comes out of DC and all the things that's going on. So I think I've done enough discussion on this daily chart, but nonetheless, you really want to take advantage of testing yourself, and don't look at I got this wrong. Try to focus on the things that you do get right in your chart annotations before you see mine going forward. Okay, not this video, but every video after this particular video that we're showing you now. All right, so this is a 60-minute chart on the dollar index, and you can see obviously there's a whole lot more business here. We have a buy-side liquidity pool here. We have a real gap. Okay, this is an actual gap in price, and just like we have an actual gap here, fair value gaps are annotated. Obviously, you can see it in here, and price moving up into them respectively, and then we have the market come down here, break a short-term high. As we got close to those levels that I shown on the monthly and weekly chart, we went into the consolidation that was really the old area of order flow. Remember what I said back on the monthly chart and weekly chart. So we went into more or less the equilibrium of that old range, but we have not broken it. We have not traded down to the rejection block or below the old low on that monthly chart. So we're digging into that consolidation, and then you always have to anticipate the likelihood of a potential reversal. That's why we teach taking partials and trying not to jam your stop loss too aggressively or trail it too aggressively, because these scenarios here may present themselves. And if we have the area traded down into, as we talked about on the midweek review, we could potentially see dollar trading higher and go up into those relative equal highs and into that buy-side liquidity pool. That sets the tone for what? Very, very short-term bullishness. But at the time, my bearishness was still in operation. I was still looking for, and I still might be there, okay? It might need to go up to this level here, clear this buy-side liquidity, and then something's released in the marketplace. Maybe Powell says something on Thursday that sets everything in motion, and then they start to drop dollar aggressively, and then euro and cable is allowed to trade higher. We don't know that yet, okay? And because it's the month of January, I'm again reminding you that this is a month where I'm not trying to just take a trade because it's possible. I'm trying to get a read on what the market's going to be doing for weeks and months, and then I'm going to operate in that context where it gives me a whole lot more probability trading with that mindset. Okay, so in other words, the momentum or direction the market moves in for weeks or months, okay, that is much more sustainable in terms of being right in your directional bias each day. Doesn't mean your directional bias or my directional bias will be right every single day. But if you're trading in that same direction, you're trading with the highest time frame institutional order flow. So it's more advantageous for you to have that. And if you try not to do that, you'll be very frustrated, and basically it's probably what's going on right now for some of you. You're looking at these daily charts to intraday, and you're not seeing the big picture that helps frame the commentaries that I do. And I'm giving you, like, I'm pulling back the veil and I'm showing you the things that I use to keep that daily chart in the right perspective. Doesn't mean I'm always right. This means that these are the things and the applications I use to help me do that. All right. And if you start doing it, you will see that there's a stark contrast to not doing it, and when you do use it, it's very helpful. So we have a market structure shift here when we have this short-term high broken on the upside, and it comes back down in. We have an imbalance here, and then we have the order block, which is the last down close candle. We always want to use the candle that has the biggest beefy body candle or the lowest close, okay, in that order of selection. So I'm looking for the biggest down close candle, because there may be like this one here. Even though this has, again, this could have went a little bit lower, but because it's broken over two candles, I would have elected to use this one, okay? So there's an hierarchy there. That's algorithmic, okay? That is not a rule that has been shown or taught and broken down with the specifics. And this is the reason why I get upset when I see people that just watch my videos and they think they're going to go out there and start getting ad revenue on YouTube, making videos about order blocks, and they have no idea what they're talking about. There's a specific order and hierarchy of what you're supposed to be looking for. That's how I can find the right ones and do it with live trades and show you examples of me doing it versus everybody else talking about on the left hand side of the chart. So we have an order block here, the high and the low. That's the entire range. You can see we traded back down to the mean threshold of that. Moving it back above this high here, because we have a higher low than this one here. Now think about like the breaker. The mitigation is the failure to make that lower low on this run. So in other words, if this one went lower and then price did this, this would make this a breaker. But because we have this low high that breaks the short-term high here, when it comes back down, if it runs back above this high here, this is simply a mitigation block. And for those that are brand new coming in, that is taught specifically. You have rules about that too, and it's all taught in future lessons. But right now, what I'm giving you here, if you have questions as you're watching these videos, you want to write down the date and the things that came to mind as far as a question about whatever I'm talking about. And in this video, we're talking about a lot. So right away, you're going to say, what's the difference between a breaker and a mitigation block, and what's the advantage of knowing that difference? Well, when we have a potential contrarian price move, okay, in other words, we've been bearish on dollar and we are anticipating lower prices on dollar. But if we have something like this occur where the structure is now seeing a shift after it's traded down into a level where it potentially could turn, we don't know. We're likely to side on it going lower, but if it does give us indications that it want to go higher, that is something that we have to be concerning ourselves with, which is why I mentioned on the midweek review that we could potentially trade higher in the dollar index and need to retrace deeper. If it doesn't make a lower low here and then trades back above it, this is going to be mitigation. That means that they're going to be wanting to use this level here as you would expect a classic support resistance idea, but not just to the high. In other words, because if it was that easy, it would be just this high here, draw that out in time. Well, it went below it here, and it went below it here, but then still went higher. And these are the things that I encountered as a new trader in the 90s, where I felt that support and resistance was a trick. Like it didn't work. I couldn't make it work. Just like trend lines. Everybody can find the perfect trend line after the fact. But the key is knowing what you're looking for when the chart's alive and breathing and creating the candles. That's the difficult part. So what my endeavor has been through my whole career was to decipher why it needs to come back to this range here. Okay, what range is that? The high of this candle and to the high it creates here. So when it comes back lower, once it breaks above this high, I'm concerning myself with this old turning point. I'm also referring to this candle's high here and this candle's low here. That's your fair value gap. So if it does need to trade back down in, we have institutional order flow entry drill that could happen here, or the mean threshold, which is the midpoint of any gap, and extend that out in time. You have it here. What's interesting is if you take this swing low here, and it's a low that has a higher low to the left and a higher low to the right, you can also have this on your charts too. In this low up to this high, why this high? This is the highest high prior to this dip down that went back into the fair value gap. This is an optimal trade entry. And just running back from here to here, that's a trade. That's a scalp. That's a bread and butter setup. And it doesn't need to go up into this gap here or even go to this buy sell liquidity pool to have profitability. So that right there in itself is a complete model. Knowing that we could potentially be turning in here and still hold a bearish stance longer term, but on a short term, you can take scalps or intraday trades based on the market structure that's here and work with this context. So that's what I mean by studying and looking for certain things. And when you have your charts annotated and you refer to them on a day-by-day basis and on the weekends, you want to look at the previous week and the week before and how you had your annotations, what the charts presented as a future response to that old area of order flow that you outlined. And just like this gap here, the market gravitated to that. Look at the bodies. You see that? It's respecting this area right there. So the algorithm remembers that. Does it mean it's done? No. It just means that this sensitivity here is directly related to this low end of that gap. So this is the discount end of that gap. This is the premium end of that gap. And then consequent encroachment would be the midpoint. And it just about gets there. It doesn't quite get there. But everybody's data, if they looked at a live chart or a live platform, their brokers quoted high on this particular candle here would be different. And some of us would see the consequent encroachment level hit. Others would probably just be above it. Or like in this case here, we look like we just fell short of it. But nonetheless, that's not what's necessary. Knowing these turning points that set up these price runs here, that is the basis to finding setups. Now, obviously, I'm not stating that you should be doing that because it's non-farm payroll and you shouldn't be trying to trade those days, but you can still use those days to study how liquidity is utilized for intraday price delivery. All right, moving down into the 15-minute time frame, you can see everything that's been transposed from the higher time frames to the hourly, and then now those levels are brought to the 15-minute time frame. You can see that order block. Now, notice that it's a little bit above halfway of all these down close candles, and that's why knowing the higher time frame levels and putting them on your higher time frame charts, and then using that when you're looking at your lower time frame, like 15-minute here or even a 5-minute chart, it gives you such a degree of perception that you can't really appreciate. And right away, some of you are smiling and nodding your head like, man, I have been wasting all this time, because if I just would have said the things you give in the commentary and applied them to my chart, and when I looked at my lower time frame charts, I would be seeing these things. Yes, yes, that's what I've been trying to tell you all this time. All these years I've been telling you to do it, but it strips you of that aha moment. And that's what I want everyone in here to have. So for the most part, it still can happen, but you have to be careful not to look at my chart before you have yours done. And then right away, it'll get you up to speed quicker. It's not meant to rush you through the mentorship. It's just meant to get you thinking more about involving yourself in your own study, being interactive with your charts, and then comparing and contrasting what I see as salient in price versus what you're looking at. Now, as you go through each month, even those that have become charter members, as you go through the content again, which is what you should be doing, you should be absolutely going through the content again. No one learns this going through the mentorship 1 or 2 times. But Michael, that's a lot of videos. Yes, it's almost 3 decades. What do you think's still coming? It's a whole lot more information. And it'll be easier for you to digest that if you go through the motions of going like this last group that's in 2021. They will have the highest amount of hand-holding that any group has had. Now, the first group is going to be like, oh, that's not fair. You should have did this for us. But you have the most insight. So you'll be able to glean more insight from going through it again. And with the new way of presenting these commentaries, you'll fill in your gaps that you still have a lot faster and a lot more efficiently than the new group, because they're going to have that whole discovery period too. They're going to have that don't know what I'm looking at. This is too much information. You went through it too. So, and if you're new and you're going through this, just know that you are going to get a tsunami of information, and it's not meant to disorient you. It's not a quick fix, hurry up and try to learn it all, because you're not going to. But you subscribe to this to be able to be a market wizard, if you will. You want to be able to look at the markets, any asset class, any time frame, decipher what it is, what it's going to do next, and have a 90% likelihood of being on side versus being offside. In other words, being on the right side of the marketplace. Now, notice I did not say 90% profitable. Okay, there's very specific terms that I avoid using here because of legality. Okay, if you do the work I'm telling you to do, I promise you, what you want to do, you will have the skill set to do, and you fill in the blanks as what that means for you, because I promise you, it will be available to you in your own skill and experience. But what you put into it determines your outcome and the results while you're here. Okay, so, and it's not a hurry up and quick fix, get me rich fast, show me how to learn how to trade in 6 weeks, or boot camp. Okay, that stuff doesn't work. Nobody goes through short-term teachings and all of a sudden now they're a market maven. It doesn't happen. Believe me, it does not happen, because I would have been corrected and shown by thousands of different yahoos out there that have pretended that that's true and sell courses and such. They can't beat me, and their students can't beat me. So again, it's not an ego thing. I'm just telling you, just look at it for what it is, because if they have the skills that they pretend to have, they would be able to do the things that you see me doing, and they don't. But you're going to be able to do these things. And once you have that skill set, no one can take it from you. But it's not going to come overnight. And every day you grow a little bit more. You whittle away at the rough edges, sand out some patches of rough ideas and understanding. And every day you get closer and closer, and that rough corner becomes smooth over time. And then over more time, you use a finer grade of sandpaper. And it doesn't feel as much change is occurring, but it is. And you're really smoothing out those minor little imperfections. And over time, you do more and more and more of that. And finally, you have a real smooth edge to everything. And you're not cutting yourself just being the analyst, hurting yourself. You're able to be fluid in any time frame, any asset class, any market. It's just an empowerment that I can't really articulate. But if you don't do what I'm showing you here, there's one absolute result. You will not learn what you came here for. Just know that, and you'll see if you go back and look at the other commentaries, I'm not doing what you're going to see me doing in this year anywhere else in any other mentorship. Like I haven't done this. So I'm making it available to you, so that way you can compare and contrast. So that way it'll get you closer to the market. You'll be more in tune with what's likely to happen next. But I'm not giving you trades. Okay, it's important to know that. But you'll see how the markets move and work off of these levels going forward, and more specifically, why they did what they did in the past. So I'm blending both of what you need to find in the marketplace that's salient, that leads to future price moves, that helps you with your prognostication. So anyway, 15-minute time frame, you can see we have the mitigation area in here. We hit it once in here, but left this imbalance and the order block inside of that fair value gap, which is defined by this candle's high and this candle's low. Remember, we're not defining it on the 15-minute time frame. These levels, go back and look at the previous chart time frames, and all we're doing is going down in the lower time frames once we have applied these levels on higher time frame charts. And then once we have them, we look inside of this candle's high and this candle's low, what resides in here. And we have a down close candle right there. So you have an order block within a fair value gap. Now, that order block might not be there. It could be a smaller fair value gap. Then that's what I would use. Okay. But because we have a down close candle in here, that's the order block within an imbalance, which is the fair value gap. And again, you'll learn what fair value gaps are by definition. If you're new, you're probably asking yourself, you keep talking about what a fair value gap is, but what is it specifically? You get lessons, okay? But you have to go step by step, okay? You will learn all these things. But I have to talk in the commentaries with the assumption that you're going back through the content. And this is why you have to do multiple passes through the mentorship, because repetition is key. And you'll know what I mean by watching a video that I did in 2016, 2017, 2018, 2019, 2020, and what I'm doing right now in 2021. Once you become a charter member, if you go back and look at those same videos, you're going to be astonished of the things that you're going to swear up and down that I made a different video. And I don't edit anything. Okay, let me toss this in real quick. For those that are month 12 content, there is and I may have the date right, so forgive me if this is incorrect, but off the top of my head, folks that have just rolled into month 12 level, there is a lesson, and I believe it's August 16th, part 2. It looks like it is messed up or whatever. When the video stops, that's really where I wanted it to stop, but it had an artifact in it, meaning like there's a call out or a little thing that I would use during the production of the video. So it made the timeline longer than it really was. And I don't edit anything. Once I put the video out and people can see it, I never go back in and change it. It's the litany test for me. I can't change anything. That's why you should download everything. But I say this to remind you that when you go back through and watch old videos, once you're charter level, you have gone through core content and you'll have access to trading models and trade plans. When you go back and look at old videos, it's going to feel like you are watching that video for the first time, and I'm teaching with a greater level of description and or detail. But it's the same video. It's just you have blinders on right now and you're not listening for the right things. You don't know what I'm referring to and its importance right now because it's your first pass through. And you haven't been exposed to the other lessons you'll have later on. So trust me, it's very dense. It's a lot of content here. And everything that's like what I'm saying right now, everybody complains about you talk too much. Get to the point. Once you're a charter member and you've been here for a couple of years, you're going to see this is all the point. The talking points is the point. It's not the thing in the chart, because there's a lot of things that need to be weighed in context. And the way you know context is understanding narrative. But you can't understand narrative until you understand the individual pieces that make up the PD array matrix. And you'll learn about that too. But I just can't give you everything, not because I don't want to, because I would love to have been able to do this. Just make it one time and there it is. And it's in one video. But I have so much understanding that I want to share with you that will help you, but you have to go through it with bite-sized pieces. And then once you do that, you will have a vision of why price does what it does, and you're not surprised by majority of what you see in price. And here's the important thing. This is why this lesson's important. You're going to learn why I choose not to touch a particular market. And it may be, for instance, say you're going to be a futures trader. Now, some of you are nodding your head thinking, yeah, I'm going to be a futures trader because I understand it's being taught here. Others are just in here because they want to learn Forex. Some of you may come in here and have just Forex on your mind, and you may end up becoming a bond trader or a stock option trader. Okay. You will determine who you are as a trader and what you're going to do. But these things that you learn are going to shape you, and you have to be aware of where it's leading you. And I don't push anyone in any one particular direction. Predominantly, I'm Forex because that's kind of like my forte. But obviously, you'll learn that all this stuff works in everything. And like in crypto, I was able to outline the big move this year going into 40,000. And just using the things that you're going to learn here. Now, I don't teach crypto. I teach price action. So the things that I use and lean on are going to be beneficial to all asset classes. But you may not feel that it's appropriate for you to trade stock options. But learning about them is good. You may not feel that it's appropriate to learn how to trade bonds. But even if you don't trade them, in certain market environments, it's important to understand them because it helps I guess, support a underlying quarterly shift that you'll learn about also in the marketplace. Quarterly shifts are like every 3 months or so in the marketplace, what direction it's likely to go. Okay. So this video is way longer than I really wanted it to be. But just know that all these things that I'm talking about are the basis of why you're here. It's not the little bells and whistles that I'm teaching you, the little tricks. It's the logic. Because I can give you a paintbrush, I can give you a blank canvas, and I can give you the finest paints, whether it be oil-based or water-based paints. And I could say, okay, in theory, if you take your paintbrush, dip it into the paint, and draw a circle or paint a circle on the canvas, you're going to have what everybody will know is a sun. Now, if everybody went in there and did that, some of you are going to drop the paintbrush with paint on it. It's going to fall on the floor. Other people are going to stick the paintbrush inside the paint can, then go up, and then paint's going to fall off the brush onto the canvas in areas they didn't want to apply it. Other people are going to say, I don't see a sun that's yellow. It's more of a orangey, that hue. And everyone's going to have their own personal interpretation. And everybody's results are going to be different. And when you're coming through the content here, that's why I tell everybody not to talk to other people. And that's the number one reason why you are not allowed to talk to other members. Because as soon as you start comparing and contrasting what you are feeling or what you think you understand with other members that are in here learning just like you, there's going to be times when you think you know what you're looking at and you think you understand it all. And you're like, oh yeah, I got it. And then as soon as that happens, you're going to walk around your house. You're going to walk up to your spouse and think, yeah, this is the best investment I've ever made. ICT is going to make us rich. You're going to be prancing around your house. You're going to be happy. The next day, you're going to wake up. The market's going to do something. You're going to feel unsure. And then when I teach something new, you're going to be like, why didn't I see that? Oh, I thought I was learning something. And you feel like you went back to zero, step one, and you're going to feel deflated. That is normal. But imagine if you're listening to 15 other people in the mentorship and they were going through the learning process just like you. So in other words, while you're making payments, I don't let anybody talk to another student in here because it's going to be a distraction and it undermines your development. Whereas if you have that moment where you look at these things and you test yourself by looking at certain things in the chart, in the first couple months, don't even expect to have anything on your chart that resembles anything that you're going to see in mine because you haven't learned enough. When you go through the lessons, about month 6, then it'll start feeling like you can start seeing some things. But that's realistic. That's how I'm pre-warning you all, okay? That's not a sales pitch to make sure I get 6 payments from you at least, okay? Because clearly, if this doesn't match up with what you think you're going to be able to endure, then just don't go to month 2, okay? Because it just gets more detail, more work, more effort on your part, and it's a lot of study. But the people that go through it can see why I do what I do and how I can call the markets. And the things that led me to that is the things that you're learning. And there is no shortcut to it. There is no, oh yeah, ICT doesn't teach good. He talks too much. Other people take his concepts and they teach it better. No, the only thing they're doing is they're taking people right to a chart that has nothing to do with live trading. They're not taking a trade. They're talking about what's already happened and they're being fooled by hindsight. Just like everybody feels when they read books. Think about it. When you buy a book or bought a book, you read it and you see the examples. You're like, oh man, this is going to be so, I can't wait till Monday. I'm going to start trading. And how's that work out for you? You can be fooled by that stuff. And that's what these shucksters are doing. They're out there scamming people. And if you can't see what's going to happen, like why aren't they doing it with live charts? Like record your stuff. They're making recordings. Talk about what's going to happen in the live chart in that recording. But none of them ever do that. You're going to learn how to do that skill set. You're going to be able to look at the chart as it's alive and breathing and forming the candles before it even moves to these levels. You are learning how to see it before it happens. You don't need to have trickery. You don't need to have any of these hindsight hero stuff. You're going to know exactly what it is that you're looking for in the chart. And when it forms, you're going to know what it means and how to engage with it. And like I'm going to show you when we get into the British pound portion of this video, what it will look like and why you should not touch it. That's a very, very big lesson. And I purposely chose this lesson because I want the new people coming in that if you learn nothing else from me in this mentorship, if you learn how to avoid the problematic periods in the year of trading, you're going to give yourself the greatest advantage than the people that go through the whole business of trying to learn how to trade, buying books and courses and learning from people that don't know how to trade, that never made any money or even have any experience in knowing why they shouldn't be trading at all. Knowing when not to do something is the most important, because I lost fortunes by not knowing that lesson that I'm going to show you here tonight. So if I was to have everybody in a room and all together in one place, and I say, okay, raise your hand right now, okay, if you want to learn how to avoid losing during the worst periods of the time of drawdown, you know, if that would be an interesting lesson for you, raise your hand. I guarantee you would see heads turning left and right to see who wants to raise their hand. I don't want to be the one that raised their hand. I mean, I feel like I should raise my hand, but let me look around. Is anybody else wanting to do it? But that's the lesson everybody should be looking to learn. That's the first lesson, how not to lose money. But nobody wants that. I could write a book just by that title and just teach this topic tonight. And honestly, nobody would buy that book. But that's the book that makes you rich. Because everybody can get lucky like I did back in 1990s, where I got lucky for 9 months. 9 months. I got lucky. I was on the right side of the markets because the markets were one-sided. I didn't know all these things that you're learning here. But I learned through pain and losing and blowing accounts over and over and over. Oh, this is what I should have been avoiding. These were the warning signals and as I teach now, signatures in price that I should have been aware of. And if it starts doing this again, I'm not touching that market. And I don't care what it does. And honestly, that is the most important lesson you're ever going to learn as a trader, because you can make money being lucky. Hit and miss, short little scalps here and there, get 5, 10 pips here, 8, 6, 7 pips here a couple times a day. People do that all the time. But what happens is they get into a losing trade and then they lose their mind. They're like, I got to get that back. And they start doing all this other stuff, trying to do 1,000 different trades. And then they whittle that win or that series of wins down to drawdown that becomes even greater drawdown. And then you're like, okay, I can't stand this. I can't go home with 12% loss. I got to get it all back. And then you turn into a 40% loss because you overtraded and you got mad. Now that's the extreme of it, but that's what happens. Everybody blows their account the same way. Losing control and trading, forcing trades in environments that they should not be trading. Period. It always happens like that. Always happens like that. It ain't, oh, well, retail traders lose because they're just trading retail logic. That is a large contributing factor, but the things that I just mentioned, everybody loses their account that way. So if you can deduce it to what are those things look like, so that way you don't fall victim to it. That's what I'm going to cover tonight. But you can see how we traded down into the order block, trade some sell side liquidity here inside of the range of the mitigation, and come back not all the way to the bottom of the fair value gap that's framed here, but come real close to it. But it hit the order block. You see that? It hit the order block. Look at the bodies respecting. So we had one little candle make a tail into the order block. This down close candle is the order block inside of the range between this candle's low and this candle's high. This is framed on the higher time frame chart. And again, go back and look at that where it was, and you'll see that that's what's being framed here. So the market drops down into it in a time when I said that the likelihood of dollar retracing into those relative equal highs, and in non-farm payroll, which we won't trade, we don't do that, but you are encouraged to study it, Study what non-farm payroll does, because it's a beautiful lesson on liquidity. But the market runs up, comes back down into or area of order flow, and then rallies up into the gap. So having levels on your chart like this, it shows where the market reaches to and where it could potentially turn. So you want to know where it can reach. That's the primary, that's the first thing you want to be inquisitive about when you look at price action. Like, okay, what's it likely drawing to? And you start by a higher time frame chart like monthly and weekly and daily. Where is it trying to get to? Even if it fails getting to that specific level, if you're trading in that direction, you're likely to find consistency and profitability. That frames the institutional order flow perspective that I teach you here. We're not trying to pick the absolute high and the absolute low. That's not essential. But knowing how to find the draw on liquidity, where is it likely to go on these higher time frame charts? If it's likely to keep going up over, say, the next 3 or 4 weekly candles, is it safe to assume that you buying in New York, on a Monday, Tuesday, or Wednesday, what's the probability of you finding a winner there? I would submit that it's pretty high. Assuming, again, all things being equal, that weekly chart does in fact have the likelihood of it going up for 2 or 3 weeks. You're going to be capitalizing in on that expansion on the weekly range. Whereas if you're looking at a 1 minute or a 5 minute chart and you're trading in New York and it moves 30 pips for you and you're like, oh yeah, I'm a winner, I'm getting out. There's nothing wrong with that, but you are also cutting yourself off of potentially finding a runner because of you avoiding holding on to something that you framed on a weekly chart. So again, it gets back to finding your niche in all this. And if you want to just be a 20 pip or 30 pip trader, there's nothing wrong with that. There's lots of those every single week. But if you don't know what you're doing and you don't learn the lesson I'm going to give you tonight, you will overtrade in periods when you shouldn't be trading, and you'll present drawdown that causes all kinds of internal wrestling. And you have this toxic thinking about, I can't sit with my account in drawdown. I opened my account up with $1,000 or $5,000 or $10,000 or whatever you opened your account up with, and it's sitting like negative $1,200 or $1,500 or worse. If you can't sit and wait for the next setup just because you lost on the last trade or series of trades, and you feel the rush to get in, you need to go back to demo. That's a number one lesson. If you go into live trading, if you feel the impulse that you have to trade because you can't find contentment in between setups while you're in drawdown, you need to come out of live trading. Stop. Go back into demo. Wait until you can do 6 months consistently without a great deal of drawdown, and then maybe consider going back into live trading. But you have to know these thresholds. You need to know how to fix them and know what it is that you need to be correcting, because mindset will blow it out of the water. Your account could be roasted immediately. It doesn't matter what I teach you. If you have a poor mentality about trading and over self-control with yourself, it doesn't matter what you learn from me or anyone else. You will use it as a weapon to hurt yourself. And that's why it's important you know trade psychology. And it's important that you know what you're going to do to derail yourself. And that's what the first 6 to 7 months here will teach you. Because that's the part that breaks everybody. The internal sabotage that everybody does. Everybody does it. I did it. Everybody does it. It feels like you're losing your mind. Like it's like, why am I doing this to myself? I knew I should have never did this, but yeah, I still did it. That's all impulsive actions. You need to find control mechanisms, and I teach you that here. But it's inside these kind of boring discussions, because the books don't do that for you. Even Mark Douglas doesn't do that for you. Rest in peace. God bless him and all that business. But the point is, that book is championed by everyone, but it still falls short of the lessons that you learn from me, because I lived that. Okay? I really lived it. And I watched money hemorrhage out of my accounts, plural, because of the lessons that I'm teaching you now that I had to learn through pain. And when people learn them, they avoid those same mistakes. Some people feel like they got to have the scars. I went through it too, ICT, like we're military and showing our Marine tattoo. I'm like one of you now. I don't want you to have those scars. I want you to be able to say, you know what, I'm so appreciative that you taught it this way, and I didn't have to have that pain and suffering. I can appreciate not having the scar. That's what I want. As a mentor, that's what I'm trying to spare you. I don't want you to go through the hard lessons. I want you to be aware that this is what's going to happen. So that way, when it does happen, you didn't listen and you're like, oh yeah, he was right. I don't need to do that again. But some of you in here, and you know who you are, you just keep doing the things that I tell you not to do, and you don't do the things I tell you to do. And it's very important. If you don't listen to the things I tell you and the things I tell you not to do, are you really submitting to being mentored? No. So why would you be upset or surprised at the results? I know it's hard. It's difficult. And that's why I said it's very expensive. It's not because of the money, because I could sell this for a lot more money and people would pay it. It's expensive because it forces you to learn who you are. And when you start looking at these charts that I'm sharing, and you do the tests of putting on what you think is salient on the chart, and then seeing what I'm showing you, not only am I doing what I'm already doing in the past, where I'm commenting on this or that, I'm showing you what it is that you're supposed to be looking at and seeing. So I'm doing the work for you. Now, the worst thing you can do is don't do the exercises of dressing up your chart before you look at mine in the videos. If you do that, you are doing no service to yourself. And what's going to happen is you're going to watch it. Then you're going to watch how the market reacts. Okay. And then you're going to be like, wow, yeah, this stuff works. And what that does, it gives you a false sense of security. And for some that are weak, and I don't mean it to be disrespectful, but those that are in here that are weak-minded, you're going to be tricked by that. And it's going to give you this false sense of security that you should go in there and start trading. And then because you have not done the exercises and the practice of trying to annotate the chart and see what it is that you should be seeing in the charts, and then testing your perception against mine. Now, some of you that are new, make the new group coming in here, some of you are cynical. I don't know who you are yet, okay? But some of you may be like, oh, of course, you're going to have the benefit of hindsight, so you're always going to look right. And when I do it, I'm always going to feel wrong. So that teaches me to look at you as the superior and me as the inferior, so that I have to keep making that monthly payment. I already know where some of you are thinking. I want you to test what the market does based on the things I show in the chart. That's the lesson. But you won't be able to do these things unless you put your nose in the chart and do it. The only thing I'm doing differently is I'm giving you more details in the chart, whereas I was refraining from that in all the previous groups. But because we're trying to wrap up the bulk of the teaching in 2021, I kind of want to give everybody that last little push, and also hold the hand of those that are just coming in. Because it's real easy to talk yourself out of this. Real easy. I could find something else to spend my $155 on a month. It's a whole lot of other things I can waste it on. And be miserable because you didn't do anything. Didn't change anything. You didn't take real initiative. But if you do the things I tell you, I promise you, you are going to see the results. You're going to see it. It's impossible for you not to, because your head's going to be in the chart. You're going to be looking for things that you're being trained to see. And even if you don't know what it is that you're looking at in my chart, by repetition, me pointing it out, it's going to be pattern recognition. It's going to be a concept that's taught conceptually by repetition. And then you're going to start saying, oh, this looks like that thing he keeps, and then all of a sudden, it'll do something like that. You'll have that epiphany, that little thing, that aha moment, and then you take that moment and you verbalize your feelings, how it makes you feel, how you are excited about it, and you put that in your study journal. And then when you have periods of time when you feel like you're miserably struggling and you feel like you're in a rut, go back into your journal and read those times where you had a really good moment. And it energizes you. You're like, oh yeah, I did have that moment, and it came out of nowhere. Right now, it's a temporary setback. It's a temporary speed bump. Or right now, it's January. We don't have a lot of expectations in this month. So you need to be able to manage your psychology and your psyche about what it is that you're doing. Because if you feed yourself toxic perspectives or say, I'm never going to get this, or this is too hard. Okay, those things, that's a negative reinforcement, and your subconscious is going to remember that. And what that means is every time you watch my video, subconsciously you're going to start thinking, oh yeah, this is all hindsight. Oh yeah, because what you're basically saying is this is too hard. This is more work than I thought it was, and you don't want to hear me talking, because it just reminds you that how much effort that you're going to have to put into this. It's easy for you to put your fingers in your ears and just say, I'm not listening to this. This is nonsense. When the whole thing is right in front of you, and how to get here is being described and outlined for you. But just like working out and building muscle, you have to break the sweat. You have to move your body. You have to do the things that put your body in motion to get the results you're looking for. Watching exercise videos, listen, okay, there's a lot of people online that make exercise videos. YouTube is full of it. You can sit there and watch those things all day long. You're never going to get a six-pack watching other people move around. And you're never going to learn how to do these charts. You're never going to have the perception in price action until you get in and you mess up. Put your attention on the wrong places and then discover, oh yeah, I was doing that wrong. I don't need to beat myself up about why I was doing it wrong. I just discovered what it is I'm doing wrong. So I avoid doing that and do the thing I should be doing. That's progress. And it's not immediate. It's important that you understand that if you're entitled-minded and you think you're supposed to have it right away, or I'm not interested in you learning at a quicker pace, because some of you come in here like to think that you're, superhuman, and I'm going to be able to digest all this. Trust me, Michael, I'm going to be able to do this a lot faster than you're used to seeing. And then they send me emails when they're charter members like, man, this is a whole lot worse than I thought it was going to be. This is a lot of effort. Yeah, hello, because they rushed through all this core content. But if you listen and you do the things I tell you, I am your college professor, okay? I'm going to do a lot of this stuff here, lecturing, because I want your mind on the right things and avoiding the wrong things, okay? If you listen and you avoid the things I tell you not to mess around with or put your attention on, you will have every advantage. If you do not listen and you dabble into chat rooms and you dabble into looking at people on Instagram and worrying about what they're doing or pretending they're making, you are taking your sights off of the work that's necessary for you to grow here. For those that just started, and it's the 27th and maybe you got to this video, you've seen how many videos just popped up on your forum. It's a lot, ain't it? It gets worse. There's so much content ahead. And I want you to just relax. Take one video at a time. Fall in love with learning this, okay? If you forget about money and you fall in love with figuring out what these little wiggles and waggles in these charts are doing, I promise you trading is going to be amazing for you. It's going to be fun. It's a journey. But if you have a timeline that I have to have this figured out by this time, you're never going to learn this, because you're too worried about beating the clock. It's a lifestyle. And once you love it, you end up becoming, well, in love with it, really. And it consumes your life if you let it. And that's why you have to have a balance, okay? You hear in my YouTube series, if I could talk to myself as a younger man, I actually got emotional a couple times in there, because I was telling you right from the heart the pain that if you don't listen to me, you're going to have that. And it's not fun. So avoid it. Make it the best experience you can make it by listening to someone that's gone through it. Now, I can show you how to make money, but my important lessons is more aligned with how not to hurt yourself. Because if you listen to those lessons, you're going to have a real chance at making money. But if you don't listen to those lessons, I don't care how good you get at trading breakers, order blocks, optimal trade entries, all that stuff. Eventually, you're going to hit a period where the markets aren't giving you what you think you should be getting. And you're going to test it. You're going to get in there and you're going to lose money. And then the loser cycle starts. And you'll blow the account. But you know how to trade, but you don't know how to control yourself, and you don't know how to selectively take yourself out of the marketplace when it's the right way and time to do it. So anyway, let's go on into the euro dollar. All right, so here's the euro monthly chart. You can see we have the rejection block, which is the highest up close candle, closing price. And then we have the high here where there's buy side liquidity resting above that. So these two PD arrays are the next ones in line if we're going to have a continuation on the upside. So that supposes that the dollar index does in fact go lower. It may not get there right away. This market may need to come back down into its order block here as outlined here. We do have a little bit of a buy side imbalance, sell side inefficiency with this one single candle. So what's not being shown here is this candle's high and this candle's low. That right there is in my mind as a imbalance that may need to come back into. It doesn't need to entirely retrace into it, but if the dollar does trade higher, then we could potentially see euro dollar correct down into the order block. We do have a fair value gap in here where we had institutional order flow entry for the monthly chart. Notice it did not come down to consequent encroachment, which is the midpoint of this candle's low and this candle's high. This buy side imbalance, sell side inefficiency had it see a revisit of some of this range, but not all of it. It went down this far and a little bit lower on this one before it started trading higher. I still believe on a longer term perspective that euro will want to go above this. Now, things might develop in the marketplace that makes me change my mind about that. But as of right now, my long-term 6 months out view is that this high should be traded to and through. How we trade over the next coming weeks will determine the likelihood of that happening, obviously. But I want to see, is there any sensitivity at that order block? Should we trade down to it? I'd rather see it not close in this entire range up from this candle's high. I don't want to see it come back down into that. The better scenario would be is maybe come down a little bit and then go higher. That's what I'd like to see. And that's kind of like what I'm making room for in my analysis. Yes, I think the dollar could go up a little bit, but it's a short-term correction in an overall bearish market. I don't see anything bullish about the U.S. economy right now. I don't feel that anything has really changed yet. We just need to be bouncing around probably for a range. And then that same thing is being expected here on euro. If the dollar does consolidate, euro will be consolidated too. Kind of like what we see here. Okay. Just a smaller one of that in here. And then potentially running up into the 126s. That's kind of like what I'm looking for the next 6 months. I'm providing a lot of time, 6 months, but it could happen in, the month of February, or it could even actually happen, before January ends. I'm presenting it in such a way where at the beginning of the year, I like to look at what I think could happen in the next 6 months. And when we get to June, I try to predict based on running scenarios and looking at higher time frame charts, what's it likely to do in what direction? And then I look for things that support that narrative. So I'm giving you the bones, if you will, of how I do what I do. All right, moving into the weekly chart. I'm gonna try to move a little bit quicker. The levels that were on the monthly chart are shown here. And we do have a fair value gap there that's refined on the weekly chart. So we're using the actual weekly range from this candle's low and this candle's high. So we have a fair value gap here, which overlaps inside of a bullish order block. So if we drop back down in, that could also be an area to watch for a formation of a continuation on the upside. If we trade down through it, say we get through this candle's high, so you trade down below it, it could dip into this little gap here, or fair value gap. I'm not interested, at trading at that one. I would have to demand some price action, start moving up, and then if it could find some support back in this fair value gap at that time, then we use those levels, as you'll learn in the core content and the commentaries. We can revisit these fair value gaps, and they'll act like support and resistance. It's supposed to, but hardly ever does. You can see the institutional order flow entry drills in here on the weekly chart. We have one here and one in here, and then finally started moving higher. Again, just might need to consolidate a little bit with a small little retracement before moving up into the rejection block. I favor the rejection block near term, and it could go there and then have a deeper retracement and leave the buy side liquidity untapped. That could happen, and that's the reason why we learn about the rejection block, because in every swing high, the highest up close, that's the most sensitive draw on For instance, like when we draw support and resistance as a retail trader, when we first learn how to trade, everyone teaches us with these books that, okay, the old high and the old low, we put a line there. And if it turned there before, it's probably going to turn there again. That idea, if you apply it to rejection blocks, and the rejection block is the highest up close price in the swing and or the lowest down close in the swing. If you use the rejection block, many times that's going to be the draw on the run into this old area of order flow. Doesn't always outline that in price delivery, but that's the one I personally elect to use because that's how the markets generally like the book. Okay. Usually we'll see guys, they'll be like, okay, look at the wicks and you draw a range in here, and that's what, forget that. It's just the closing price. That's the level that it's trying to reach for. Okay. If it doesn't take out the old high altogether, it's going to be looking for that highest up close price. And take my word for it, if you go through your charts, you'll see it on every time frame. Predominantly, that's what's actually occurring because that's what the algorithm reaches for. Okay. That's the very PD array that if you understand that, and you folks that are just joining, you're learning something that the folks that have been here for a while have never heard me talk about. I've mentioned it in passing, subtle little nuances about it, but I'm telling you, that's the price that you want to focus on as the draw. It doesn't need to get above these old highs. It doesn't need to get just to the bearish order block. It's going to draw many times just to the rejection block. Okay, and even if you're wrong and it doesn't trade there, if you use that as the basis of where the market should be trying to go to, and you're doing that with a higher time frame chart, you're going to have a lot of advantages in your analysis by using that and accepting the failures when it doesn't get there. Who cares if you're taking partials along the way? Come on, if you didn't work a full week of your job and you're supposed to be there 40 hours a week, and you got sick and you had to go home for three hours early, are you upset? Yeah, I mean, you didn't get everything you were expected to make, but are you going to die from being short 3 hours? No, it's an inconvenience. It is what it is. But you look at it this way. I didn't have to be at work for those 3 hours sick, right? So what are you focusing on? The positive. You're saying, I didn't have to endure 3 hours of being around that boss I can't stand to be around. Sorry, I'm just thinking about some of the jobs I've had now. And just, 3 hours around someone I couldn't stand. And Lord forgive me, I don't mean to speak like that, but you know what it's like. You have jobs. You don't want to be around these people. But are you going to be upset and focus on the fact that you were short 3 hours? Or are you going to be like, I'm so glad I didn't have to be there sick as a dog during those 3 hours. I went home sick. So did you get everything you wanted? No. But you're telling yourself what? You're giving yourself that little nudge to say, okay, yeah, I didn't make what I was supposed to make. I'm going to be short on funds. But look what else I gained from it. I gained additional comfort. I gained a difference of environment. Being sick at home is better than being sick at work. So that's kind of like what I try to cultivate here in your learning, is to focus on the positive things and not to be a cult like mentality, because a lot of our detractors out there like to say that I'm a cult leader and this is a cult. No, I'm actually teaching you how to think the right way about a lot of things, and you're going to be exposed to things, not just charting and trading, but how to operate a very effective life and manage your life effectively. And trading is going to reveal to you where your problems are, and you have to be aware what they are when it's being shown to you and learn how to correct it. And then you'll see that 90% of this stuff is all mental. And if you don't have the right mentality, it does not matter the things I teach you, you will still mess up because you are going to get in your own way. But anyway, can you tell I've been pent up? We've had a long break with all the holidays and such, and I just feel like I want to just go on all kinds of rants. But the fair value gap here, we saw institutional order flow entry drill multiple times going in that before moving up. If you look at the range low here to this high, if we have a measured move, it looks like we can still reach into that rejection block. So again, this low to this high, do this on your chart, draw a trend line from the low to that high, and then duplicate it, okay, clone it, and then drive it over to this low here and put the low you used here, put it right there and project it up, and you'll see we're up in this area. So it's a measured move idea. It's a very generic idea. Or if you want to look at like this, you have a bull flag, okay, classic chart pattern continuation. It also lines with a run into that rejection block. It doesn't necessarily mean it's going to run above the buy side liquidity, even though that's what I would like to see happen. If it can run just to the rejection block, then fine. But the current price structure that we have here, we have all of this wicking in here, and the next 2 weeks in the U.S., what's going to happen is there going to be another event before the inauguration on January 20th. There's some buzz about whether or not there's going to be another episode in DC with people showing up with guns and protesting. If that happens, we're probably going to have a problem. But anything can happen, and the central banks will use those things to manipulate sentiment in the marketplace. So just be mindful of that going into it. I think I said enough about this time frame. Let's go back down into a daily chart, and I want to take your attention right here. We have a small little fair value gap that's right above the bullish order block, which is also a breaker. And we have this little area here. So if we do see dollar rally a little bit more than I'm looking for, euro may need to come back down into this small little gap right there and take some sell side liquidity out. And we'll have to see at that time, it would need to immediately show sensitivity there and want to rally. If it goes through that and comes back up into this, then I would expect that to be bearish, and then I would anticipate this eventually going into that relative equal lows. In other words, if it goes below this little area right there, okay, if it goes down through that and comes back up, I would sell euro, and when at the anticipation of this being the draw on liquidity on a longer term basis, and that we have made some kind of important high here. But as long as we drop down into this and we start to rally, then everything that up here, if it hasn't been traded to already, that would be where I would expect it. But if we draw up here first, then go down here, I'm not looking for that as a buy then. That's algorithmic theory as well. So it's a matter of what trades to next gives us logic on what we would anticipate going forward. And I don't expect you to understand what I just said. But once you get through the lessons I'm going to give you in 2021 as a charter member, what I just said will be much more meaningful to you. And I know some of the new people are probably listening to this thing, what did I sign up to? I promise you, stick with it. You'll see. And ultimately, on the 60-minute chart for the euro dollar, you can see we have a point of reference. And here we have a breaker. We have a high, low, a higher high that runs buy side liquidity. We have all these equal highs or relative equal highs. People that like to see that, they think that's like a ceiling in price or resistance. And then finally price breaks through it and they think, okay, this is a run higher. It's broke out. And then it goes lower and it takes out the low prior to that new high. This is your breaker. But watch what happens when it comes down and comes right back up into this area over here, but doesn't make a higher high. That makes this a mitigation. Notice the difference here. We have a high, a low, a higher high. Contrast that with a high, a low, a lower high. This is a mitigation, this down closed candle, and the down closed candle over here is a breaker. Both instances, they are bearish in nature. It doesn't always form this, but when it does, you're not concerning yourself so much with the breaker. You're going to concern yourself more so with the mitigation block. The breaker's done its job, but this becomes a shift in market structure when it comes down through the breaker. And then if it runs back up in here, then this could lead to a sell. But I don't like to sell against the underlying order flow that I think is in power. What am I saying by that? I've been bullish euro, bearish dollar. The fact that we did this, okay, when running below this low here, I don't see that as a break in market structure, if that's what you're thinking. I see that as running stops, and then I have to see, do we take out the high? If we don't take out the high and then it comes all the way back down and blows out through this low here, think about what I'm talking about here. I'm giving you logic. I'm giving you scenarios that would lead to when and why I take action. When do I take a trade? How does the trade form? all this price action, we're expecting higher prices in euro. You'll see this in all the commentaries. We were bullish, 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 bullish. But once it makes a higher high and then it breaks down, that sets the stage for a breaker. But if we run higher and then don't take out this high and then take out that low here, this becomes the shift in market structure from bullish to bearish on the near term. It doesn't necessarily mean it's a underlyingly clear reversal, if you will. It just means that on the short term, using market structure, this is indicating that everything that was taken out here on a sell stop for the longs, when it rallies up here, traders that did not have their stop here will now have their stop here because it's starting to rally up. When it takes out that low here, this return to that down close candle's low or closing price, when that occurs, they're going to be allowed. How do you know? It's spending time in here at that level. You see that? Allowing traders that are looking for what I'm showing you here. They don't find that in books. It's not taught in anything. Okay, it's not supply and demand. This is the algorithm holding price around a specific level, so that way they can mitigate. What are they mitigating? What is actually happening? If traders were long and they bought sell stops here, smart money, I'm not talking about retail. If smart money traders bought the sell stops resting below here, they rode all this up. If they held on to it too long and got caught in this, when it comes back up here, it's the algorithm's giving those informed traders on an institutional level. I'm not talking about Citi. I'm not talking about Goldman Sachs, because those guys don't know what I'm talking about. I'm talking about the upper tier bank traders that are working for the central bank. See, the central bank, they have the delivery. That's their commodity. Price is their commodity. They set the price. It's whatever they want it to be, not what your charts say it should be. It's not what the economy says it is, because they can reprice it and make it whatever they want it to be. That's how they control the growth and slow down the pace of growth in other countries. So it's control. It's a form of control. So when you understand that, this algorithm is holding price so that way they can mitigate the losses that they had by buying these sell stops. It's staying in this period like this at this level so they can get out at or very close to where they bought without having a lot of drawdown. And then the market does what? It drops down and then comes right back up to do what? This is the indication that they would look for going short. So informed smart money traders on an institutional level, when they see this, it's returning back to an imbalance and this mitigation block. So this is a short at the consequent encroachment or midpoint of this candle's high and this candle's low. So of this one single down candle, that's an imbalance of selling. The only way that they can find efficiency there is to see price trade back up. When it's trading up, short traders are trying to enter there. When it trades up, they're trying to short there. They are not afraid to do that. And you'll see by learning from me, these are ideal optimal entries. Not optimal trade entries. These are optimal entries. These are periods where at one point this candle was all up close looking and it had no wick on it. It didn't have any of this kind of stuff. It was all just a big up close looking candle while it was still forming. As it hit the midpoint of this candle's low and this high, split that in half and you'll see it's going right there. That's what I teach as consequent encroachment. This is reasonable. Okay, it can encroach on this entire downside delivery of price. It can encroach to the midpoint of that and still not go all the way up here, and still that's a good trade. So the best case scenario would be entering there, but you can enter at this level or up in between this point here, and maybe you'll have a small, like say you want to do 10 lots. Okay, I'll give you an example. You can do 8 here, 2 here, and that would be the best. Or you can do 5 here. If it gets filled, great, and put 5 in here on a limit. If it trades there, great. Or you can do 5, 3, and then put 2 lots up here if it gets a complete fill. But you don't get a fill in those last 2, and that's okay because you have the bulk of your entry in here scaled in. So you learn scaling techniques like how to get in at the best price points and still making it available for you not to get every, the exact price point of high and low. The market does tank and then trades below this low here for sell side liquidity. We have a small little fair value gap right there. So watch that. It might need to do that return there. And we're inside of a breaker. high, low, high. Same thing I outlined here. We're seeing it again here. So it's the close to the low, lots of sensitivity in there, and we'll see if it wants to round out another run into that 121.52 and 3. So sell side liquidity is the next draw on liquidity for euro. So I think that's where it's going to try to go to. 15-minute time frame on euro, we can see that it is a little bit more clear to see all the details here. We have a buy side liquidity pool here, trades up into the fair value gap, consequent encroachment, breaks down. This is a mitigation block, and it's trading up into that also within the context of a breaker as well. So again, it looks like it's heavy. It might just need a rollover, and we're watching for 121.50, 121.52. Moving on into cable, and I'll get through this a little quicker. Buy side liquidity resting above the high, and we have the rejection block here. That's the draw on liquidity. This pair has had a lot of mess. We went down and took out sell side liquidity here. We had an imbalance. This candle's low, this candle's high, it's fair value. It overshot a little bit, went into the bullish order block, and then rallied up, leaving the fair value gap, and took out buy side liquidity we were looking for. A little bit of an imbalance in here that's basically almost filled in. And that, coupled with what I'm going to show you on the weekly chart now, look at all of the difficulty. And even though it's gone up like we were expecting it, look at how difficult it is to pick the discount array or the buy points. Okay. Again, we're transposing everything from that monthly chart to the weekly chart, and then we're refining the imbalances here on the weekly. We have a fair value gap in here, it trades down into it, muddy. Look at all the consolidation in here, and then finally breaks higher, comes back down into an area of order flow here, extending out in time. I find sensitivity there. You'll learn about how to take fair value gaps that are old and project them into the future, and we cut through candles. That also negates the idea that what I teach is supply and demand, because they don't like to cut through candles. They like fresh zones. There's no fresh zone. There's nothing stale. Okay. It's logic. Okay. It's narrative. So the market trades back down into this old area of order flow. Okay. And rallies again, falls short of the breaker, which is this low. Again, high, low, higher, high. Down closed candle in the middle, that's your breaker. We have a small little imbalance there as well. And the bullish candle in this run here, the two candles up here, once it breaks down out of that, that becomes a bearish order block. That's what's up here. So these are the PD arrays, or the upside objectives. Should dollar go lower and cable trade higher, I just don't trust this pair because of the Brexit. I don't trust this pair because of the endless lockdowns you guys are going through. And it's just showing you things that are just hard. It's a really hard read. If you look at the daily chart, it's just really hard to get a read on the imbalances. It's just all over the place in here. It's very, very difficult. So when you're looking at this price action, you're left with a very confusing thing. Even though we've been calling it higher, I have been not wanting to put my hands on it because it doesn't have really clear, defined PD arrays that makes it clear to read price. Contrast that with what we've seen in Eurodollar, and you'll see why I've been focusing on Euro. So when you have all these back and forth spiky type moves, even though it's moving higher, even back in here when it was doing it has not created really clear imbalances, fair value gaps, bullish order blocks. It's been muddy. And when there's conflicting signals or PD arrays that could lead to bullishness or bearishness, and you can argue both sides, that means that that's a pair that doesn't have a lot of probability, or at least very clean price action. And on the hourly chart, okay, you can see we were looking at this high, and then when it rallied back up in here, I said we could eventually run out these relative equal lows and trade into this fair value gap, which I think is probably going to be the case going into this week. We did trade below the lows here, didn't quite get into the fair value gap yet, but it certainly looks like it's heavy, and we'll see if it wants to do that. We do have a little bit of sell side liquidity in here that I think would be interesting to see if it runs into that, but more specifically, I'm keeping my focus there on that fair value. And on the 15-minute time frame, you can see we have the buy side liquidity, the fair value gap. We trade up into that again after the run here. That was the idea I was giving you on the midweek review. Then we spiked up into this area here, take out buy side liquidity, and then breaks down, trades into a fair value gap there, and then this goes into muddy price action. So long story short, look at this pair versus the euro dollar, and you'll see this pair is very difficult to read right now. It's got a lot of mess in it, and you would not be best suited trading this pair and not trading euro, whereas trading euro is the better option because of the purity in its price delivery. So I said a lot in this video. Hopefully you gleaned something from it. I probably confused the new people, but trust me, you're going to learn a whole lot of stuff that was talked about in this. And some of you that are charter members are probably looking at this and saying, wow, I'm getting things even still out of this now. And that's progress. So until I talk to you next time, be safe. I'll catch up with you by way of the community tab on YouTube, I'm sure, or our midweek review next Wednesday. Be safe.